Let's begin this morning with a look at how the U.S. economy is doing. The April jobs report shows unemployment dropped slightly to 3.4%, and the U.S. added 253,000 jobs. This figure beats estimates from Dow Jones, which expected an increase of 180,000.
So CBS News business analyst Jill Schlesinger is here with me in Studio 57 to break down what this means for the economy. So the jobs report came out like a half hour ago. What's the state of the labor market?
I guess it's pretty good. I mean, we were thinking 180,000. We get 250,000. This is better than expected. And the unemployment rate, let's not focus too much on it. I know this is matching 50-year lows, but we've been in this very tight range of 3.4 to 3.7% since March of last year. Overall, it's kind of interesting to me that while the economy is slowing down, and yes, we have heard about layoffs in tech and in media, I get that, but we are seeing hiring. It's starting to taper off a little bit. I smell some signs of slowing in this report, even though it beat expectations. So number one, temporary services, been drifting lower. So when the labor market's really hot, you're like, oh my God, I need anybody, I need a temp, fill that job. Since March of last year, we've lost about 170,000 temp positions. We lost more temp positions during this month. So that's something to keep an eye on. Also to keep an eye on the fact that the previous 2 months were revised lower. Normally, as the job market starts to shift, you get revisions lower, not higher. Look, still at the end of the day, this year, we've averaged 285,000 jobs in the first 4 months of this year. It's a pretty solid number, so we're not done yet.
No, I feel like this is what we were hoping for, a gradual slowdown and not like a drop off a cliff, AKA a possible recession. But when I say we, I mean the Fed, right? So we're always talking about interest rates. We're talking about bank failures. How does the labor market numbers sort of factor into those two elements?
One other area in this report that the Fed is laser focused on is wages. And wages are actually starting to come down. Annual wage growth, 4.4%. The Fed really wants to see that get below 4%. And the Fed really does want to see the unemployment rate start to drift up a little bit. And the reason is that when the labor market remains strong, even if we lose some jobs, the problem is that it contributes to inflation. So I think that part of the Fed's decision this week of raising by 1/4 percentage point was really a nod towards the fact that the labor market is still pretty strong. They call this slack in the labor market. Like, there are still people who can get jobs. They may not be the best jobs, may not be the exact job you want, and you may not want to be looking for a job if you are, in one of these sectors that's really consolidating. But I do think the Fed's going to be pleased with this report in terms of how they see the overall economy. We're slowing down. We're not going into a ditch yet. We're not in a recession.
Don't say yet.
Well, I think we should actually point out to the fact that when the Fed raises interest rates by 5 full percentage points over the course of 14 months, the most likely scenario is a recession that ensues. We are not there yet. It could happen. Powell said during his press conference, he's like, I think we're going to be okay. It's very rare historically that you have that big kind of rate increase and you don't slow down more.
And, the other factor is, we're talking about the banks, the regional banks, the collapse of regional banks. And what he had said before was, he was going to watch to see what that meant in terms of banks lending out money. If they don't lend out money, then we have less money to spend, then we're less likely to buy that expensive refrigerator or whatever, and they'll have to bring the prices down. I think that's how it works. We heard about another regional bank, PacWest Bank, potentially selling. Which means, there's a potential for another big bank to gobble it up and become even bigger. I mean, how concerned should we be about this?
There was a recent report out from Gallup, a poll that said that about half Americans say, I'm freaked out by the banking system. I don't trust the banking system. And I think it's very clear that these headlines contribute to our anxiety over that. That said, the big banks are in better shape today than they were in 2008 and 2009. And they come into this period stronger with more supervision and more regulation. I think these mid-tier banks are exposing a real blind spot in the regulation, which is they may have had a larger impact overall than the Fed and Congress thought when they changed the rules back in 2018.
Right.
So now we're going to have to go back and fix this. And no doubt in my mind that Michael Barr of the Federal Reserve, he's in charge, vice chair in charge of supervision. He's going to be looking at these rules and saying we need more regulation of these mid-sized banks because they do have a cascading effect across the economy. I don't think the banking sector is sinking, but I do think that we have now seen we have got to address these problems before they get larger.
I'm feeling good about things.
Yes.
Thank you very much, Jill Schlesinger.
My pleasure.